prices are lower. Okay, there's a difference, and there's an argument for both and different reasons for both. But just understand that cash flow and cash on cash return is critical. All right. So let's start when we're evaluating a property. The first thing we want to look at is the income, right? We want to make sure that and when I say income, that's derived from the rents. All right. So when we're analyzing a building, we're going to look at what's called the gross schedule rents. That's the potential achievable rental income. That's what is the market rent for each unit? And in the ideal world, if everybody paid their rent, that's what that would be. Gross schedule rents. That's our top line number. And now we want to start taking away from that basically. So we take away from the gross schedule rents our vacancy factor. All right. The vacancy factor is going to vary from market to market. Right now in the East Bay, well, in Oakland, we have a 4.6% vacancy rate for the city. Now, you go by the areas by the lake, there are virtually no vacancies. Certain parts of East Oakland, we have higher vacancy, maybe 7 or 8%. So it depends on where you are. But citywide, we're about 4.6%. Everywhere is different. Okay. So when you're evaluating a property, try to find out what the average vacancy rate for that area is. Okay. Minus what we also call loss to lease or concessions. So a lot of times, if you have to do first month free, a lot of that is going away because the rental market improved. But a couple years ago, you would drive around a lot and see a lot of apartments, first month free. In Sacramento, you would see 2 months free, no deposit. And really, Sacramento got hit hard. So concessions, you have to take concessions away from your schedule rent. Okay, and then what we do is then add what's called other income. So laundry, vending, billboards, additional income that you can generate from the property that's not the rents. So we take our gross schedule rents, minus the vacancy, minus the concessions, add the additional income, and then we come up with what's called effective gross income. Okay? That's pretty basic. Everybody with me on that? Yeah. All right, so after we have our effective gross income, now we're going to analyze the expenses. We take away from the effective gross income. Okay, and then just by the way, when you're analyzing numbers, you're typically going to do them annually. And if you want to then, after you break them down annually, to break them down and see what it looks like on a monthly basis, feel free. But when you're looking at numbers, you're looking at them on an annual basis. And on apartment buildings, that's important because the rents are going to probably fluctuate from month to month. You have people moving in, people moving out, that type of thing. People not paying. So look at it the annual basis, and then if you want to break it out monthly, then do so. So when I'm going through these examples, I'm looking at it on an annual basis. So we got our effective gross income. We want to start now taking away our operating expenses. So these are things, and this is TIMR is an acronym for the typical expenses you'll see. Your taxes, insurance, maintenance, more management, maintenance, utilities, repairs, and reserves. Now, these are not the only expenses. Every property is different, right? But these are the most common expenses that you're going to incur when you're running a property. Obviously, everybody's got property taxes. That's your church. You got to pay your property tax. Now, make sure before you buy that property, figure out what the current tax bill is on the property. And you can do that by looking it up at the county assessor. A lot of times, if you have a realtor broker, we can look that up through our title company connection. But find out what the current tax bill is. That's not going to be what your tax bill is going to be, but look at that tax bill because it's going to tell you the tax rate for that property, and then apply that to the purchase price. So whatever purchase, in the state of California, we get reassessed based on transfer. So when the property transferred, the price you're buying it for, you're going to take that and times it by your rate for that particular property. So that's how you analyze the taxes. Insurance, that's your property insurance. Get bids. I always recommend getting 2 to 3 bids per. Every time you buy a property, try to keep the insurance cost down. Management, here's something critical. If you have 16 units and above, Rafael, you want to make a point?
On the insurance, make sure you get replacement costs, not whatever the loan value is.
Everybody hear that? That's critical. You said replacement costs, because if something goes bad and you have to replace it, you're going to need to, right? You have to replace it. You got to pay for it. So if you don't have the necessary insurance that has replacement costs, you might end up short, and you don't want to end up short. So good point, man. Management, when you got 16 units and above, you have to have an on-site manager. So just know this: when you are running your numbers, account for the on-site manager plus the off-site management fee. Those are two different management costs when you have 16 units and above. If it's not 16 units, you do not have to have an on-site, although sometimes it's recommended. But when you're in the state of California and you have 16 units and above, you have to. So you want to put that in your numbers, all right? Utility, gas, and electric, just be aware of that. You want to make sure you're trying to buy buildings that are individually metered. Sometimes you can't get around it. Out of state, a lot of buildings are not individually metered. So just be aware of what that building is relative to the market. Budget for repairs. Budget for repairs. It's buildings break down, even brand new buildings. So just budget for them. And you can, a good way to understand what a building's, what you're going to pay in the future is try to understand what was repaired in the past. And it's not going to give you an exact number, but just know what happened in the past so you can have an idea. And then budget in reserves. If you get, especially if you have a single family house that you're in, we're talking about apartments, but we mentioned SFRs. If you buy a single family resident, make sure you put at least a month or 2 months of the mortgage payment or the total mortgage payment plus the operating costs away in the event that somebody moves out and you have to move somebody else in. Critical to remember that. All right, so we take our, we got our effective gross income, right? And we took from that all of our operating expenses. That got us to what's called our net operating income, or what we call in the business NOI. All right? So it's simply the income minus the expenses, the effective gross income minus all of the operating expenses. No. Not mortgage payment, just operating expenses. So the NOI is not in relationship to your mortgage payments. This is simply your income minus your expenses. Your NOI is what you have left over to pay your mortgage with, and hopefully the goal is to pay yourself with. So your net operating income goes towards paying your mortgage and then paying yourself. So this is our critical number. Critical, especially when you have to talk about 5+ units. When you're 2 to 4 units, that's residential income, that's the category. When you're 5+, now it's commercial real estate. It's a multifamily, residential, people still living there, but when you're 5+, it's commercial, and it's a commercial loan. The valuations are different. The valuations are based primarily on what the net operating income is. Now I have, in our typical presentation after this, I'll go into capitalization rates. I'm not going to do that tonight in the interest of time. If you want to learn more about capitalization rates, give me a call, shoot us an email, and I can get you the presentation and we can talk about that. But basically, in order to value a commercial property, any commercial property, and in apartment buildings that's 5+ units, you're going to take the net operating income and divide that by whatever the market cap rate is. Okay, every market different. But just know this, we're not getting into cap rate tonight, but just know this. If you can increase the net operating income, you can increase the value, all things considered. And then obviously you increase the cash flow, money you put in your pocket, right? So our goal is, we can't control the market, what happens in the market, but we can influence our property. And the goal with any apartment buildings, we want to try to increase the NOI, because we're increasing the value. Okay. Other terms associated with what we're doing, net cash flow. Since the NOI is what we have to pay our mortgage with, after we pay our mortgage, the money that's left over is our net cash flow. And just look at that as money you can put in your pocket. Now, you may have to pay taxes on that. Now, everybody consult your CPA. You get depreciation write-offs that come from owning an investment property and interest write-off. But if you're making a bunch of cash flow, you might have to pay taxes. So just, everybody's situation is different, just understand that. But the net cash flow is the money you can put in your pocket. Cash on cash return, we talked about that before. Here's how we calculate that. Basically, we put the money that we put our cash flow, our net cash flow, and we divide that by all the cash, the total cash invested. Now, I didn't say down payment. I said the total cash investment. Why? Because that equals the down payment plus the closing costs. I can tell you, a lot of times, what the money that an investor or buyer had to end up coming to the table with ends up being a lot more than they expected because of closing costs. Okay, so you want to try to find out what your closing costs are before you get to the closing table. Now, sometimes that's unavoidable because the title company is the one that is going to prepare what's called a closing statement. For residential, it's called the HUD-1. Commercial is called just the closing statement. that closing statement's gonna have your closing